Securitization for FRM Part 2. Welcome to the audio class, and we are going to talk about liquidity risk in a securitized structure. So liquidity risk is the risk that the cash flows from the underlying assets are insufficient to meet the promises of the securitized product. This may stem from a timing difference between assets and liabilities or due to cash flow shortages. An example would be like a semi-annual coupon paying notes securitized to fund a quarterly floating notes. The latter may result if the trade receivable collateral experiences higher than expected delinquencies, so that the pooled cash may be insufficient to meet the fixed rate bond issues against them. Similar to credit enhancement, internal and external structures can be used to support liquidity for the issuance. Now, two common internal support mechanisms are based on maturity structure and reserves. So maturity structuring is analogous to maintaining credit risk via subordination. If the maturity of the liabilities is matched with the cash inflows from the collateral pool, the timing issue is resolved. However, this approach is too simple because late payments can unravel the cash flows between even though there is no default per se. One solution is to issue an extendable note, a note with an intermediate or final maturity date. At the interim date, if the principal and interest waterfall structure is sufficiently strong, the note can be redeemed. Otherwise, the security continues till the final maturity. The other is the liquidity reserves, which is very similar to the CCA discussed in the last video. Cash is set aside for the sole purpose of smoothing liquidity problems. In particular, the funds are used to guarantee the liquidity ratio can conform to the designated credit ratings. The reserve may be created by funding at the initialization of the ABS or may be accumulated from the excess spread earned on the structure. Now, external support, which is the opposite of internal support, is obtained from outside, as the name suggests, and it's very similar to what we have been talking about, like the letter of credit or the swaps. So here we have the letter of credit with recourse that allow SPV to draw a line of credit to continue to make promises to the investor. How originator and not the SPV is liable to repay the principal and the interest from all drawn on the line of credit. Recent regulations have reduced the use of recourse LOC for several reasons. First, the new Basel Accord requires capital to be held against short-term loans which are not required under the originator Basel norms. Secondly, conditioning the payment of originator based on the performance of the SPV questions the independence between the originator and the SPV. Then we have the asset swaps. They are the derivative securities that swap fixed payment for floating payments, where fixed payments are based on a reference asset. The floating side pays a fixed amount that is over the LIBOR. The asset swap are useful for converting fixed rate assets into a floating rate assets. The key to issue the use of swaps for liquidity support is based on timing flexibility of the asset swap. The SPV pays the principal and interest to swap dealer as the cash flows are received. The dealer sends the floating rate payments to coincide with the floating obligation of the SPV. The swap dealer would provide credit protection in the event when there is a default, and the asset swap is now turned into a total return swap. To adjust for providing liquidity support only, the notional principal is adjusted downward for defaults. Now we move to the interest rate risk and the currency risk, which are again two very important risks. So interest rate risk can arise from either structural differences or maturity differences between the underlying collateral and obligation. So if the structural differences could occur, for example, when a floating rate liability is issued against a pool of fixed rate, so there is an increase in the reference rate will narrow down the spread. So this is a problem inherent with the structure. If the interest rates are sufficiently higher, it is possible that floating rate liability will exceed the cash flow provided by the collateral in any period. Interest rate can also result when collateral and ABCs have different maturities or effective life. Change in underlying interest rate can narrow the effective spread. Currency risk is a risk resulting from currency mismatch between the asset and the liabilities of the securitized structure. So the same risk management tools that are available to hedge interest rate and currency rate risk for traditional fixed income products are available for securitized assets like swaps, future and forward rate agreements. Now we move on to the mortgage-backed security and the asset-backed commercial paper. and will discuss the securitization process for both of them. Mortgage-backed securities are securitized assets backed by a pool of residential mortgages. However, the securitization process is a little different than for other assets. First, the bank issues a mortgage to a homeowner who pledged his home as a collateral. Hence, the collateral is not placed in care of the trustee. Secondly, the homeowner purchases insurance to cover pension losses the bank may suffer. Third, the government sponsoring agencies like the Freddie Mac and the Fannie Mac are large purchasers of mortgage who then issue bonds backed by the principal and interest of the underlying mortgage. The government sponsoring agencies served as credit enhancers, so there is no virtually risk in them. However, MBS are not riskless because they are very sensitive to change in prepayment and interest rate, that is the timing of cash flow. So whatever comes from the government sponsoring agencies in the MBS is having a risk, but that risk is primarily the timing of the cash flow and not really the default risk. So MBS exhibit considerable variety of cash flow distribution promised through the securitization. For example, the pool cash flow may be distributed on a pro rata basis or by tranching of cash flow, which means that we can make only a principal or an interest only strip. A common MBS structure is a collateralized mortgage obligation where different classes of securities have different seniority. While all the cases of collateralized mortgage obligation receives periodic interest principal payment, CMOs receive principal interest and payments which are then redistributed using the waterfall distribution. The asset-backed commercial paper follow the same basic structure. Trade receivable from one or more companies are pooled together, and short-term commercial paper is then issued to the investor. In contrast to ABS, ABCP does not trade in an active secondary market. Hence, the typical investor has a short horizon since they hold the security to maturity. Another difference is that ABS has a single conveyance of assets. Once the liabilities are paid off, the structure terminates, whereas ABCP on the other hand continually purchases new assets and new issuance. Receivables typically do not have a stated maturity or bear interest, so there exists a significant liquidity risk because of the fixed obligation of the commercial paper.